Ladies and gentlemen, we have very big questions, very important questions to answer today. Questions that are going to help you tremendously, not only in this price range, but they're going to offer you macro clarity. They're going to offer you clarity into how you should be trading these markets in general, right? Some of them being, will Bitcoin see a supply shock due to low circulating supply on exchanges? Another question being, when will Bitcoin end this boring phase and actually make a move? Where does Bitcoin need to get above in order to get to a place of safety? Some psychological tips to avoid falling into the traps of greed, the trap of fear that ultimately leave you wrecked in your positions because you're making decisions based on emotions rather than logic, right? So good psychological strategies being mentioned here today as well. Another one, are stablecoins secure? What am I doing personally? Am I holding my money in fiat? Am I holding my money in stablecoins? If so, why or why not? Another question there today. Another one, what else? We've got the S&P 500 correlation to discuss. Is there a chance that the S&P 500 could see a recession and Bitcoin could go upwards regardless? What's the deal with correlations there in the S&P? Just a bunch of questions here today to answer. So go to my pinned comment below and you'll see the timestamps, right? And in the timestamps, I'll show you what parts of the video I answered what questions, and you can go and select, skim through there and see which questions are relevant to you and check them out. Guys, without further ado, we'll check out the exchanges and then get into the video. Just a 20-second advertisement here for these exchanges, BingX and Bitunix, although I shouldn't really call it an advertisement because I handpicked these exchanges myself. I'm advertising them on my own accord, on my own authority, because I genuinely like them, right? They're both global non-KYC, so they're applicable to everyone watching this video. You can sign up. My referral links are down below with 15% trading fee discounts for life. Every single buy, every single sell you make on those exchanges, you will get a 15% trading fee discount. They've never been hacked before. They're low in trading fees. They're non-KYC. Check them out with my links down below and sign up. Guys, let's get back into the content. When is Bitcoin going to do something? We've been poking around for around 4 months now and nothing has occurred. That's the vague gist of the question here by MC Legatars. Okay, sure, whatever your name is there. We've got your question here and we'll answer it here. When is Bitcoin going to move? Well, look, we can answer this in a few ways. I can give you the likely scenarios, the unlikely scenarios, but if you want the absolute deadline, the absolute final deadline for when Bitcoin is going to do something, I mean, if we're talking about this descending channel formation and we're talking about the fact that we are getting pressed down very clearly by the center line of that descending channel formation, which is supported and bolstered by the bull market support band, by the 50-day and 200 days moving average, very clear resistance there. And we're also looking at the fact that we have these uptrending yellow lines acting as very strong support zones. What we can do is we can extend this channel formation and we can see when the center line reaches those support zones, and that would be called the apex point, meaning that we can consolidate until that apex point, but at the point of apex, we will have to make a move either to the upside or to the downside. And so the apex point, technically speaking, is December this year, around Christmas time. But when you look at this chart, you have to think, it's very unlikely that Bitcoin is going to continue consolidating here all the way until the apex point. What is likely, in my opinion, is that we see a move on Bitcoin within the next couple of weeks, right? I think the next couple of weeks we'll see a move. I actually said last month within August. I still believe it's actually more likely we see it this month, but if we're just giving a grain of salt to the market here, we can say, look, within the next couple of weeks, we'll be seeing a move either upwards above this center line or downwards below our support lines and then into a decisive bear market. I believe upwards is the way we will go, but we can't completely rule out the downside scenario, so it's worth talking about it as well. But yes, I think this long-lasting macro consolidation will come to an end. I think that we will see a break either up or down from the center line or from the channel itself within a couple of weeks, probably within this month. I think that's the more likely scenario. As for the channel itself, I think you're looking at next month, the month of September being the deciding point. I mean, the month of September ends here, and by that point, I think we'd be seeing a break to the upside of a channel or break to the downside of a channel decisively. So within basically 2 weeks, more likely 1 week for a medium-term move, and a longer-term move is going to be within about a month. So hold tight. I know it's getting boring, I know, but as we discussed yesterday, this could actually be very healthy consolidation. Bitcoin moved upwards very quickly, way before when it was meant to. We discussed this yesterday fully. Bitcoin usually takes around 1,100 days to go from a bull market high to a break of that bull market high. This time it took 850 days, right? So it took 250 days earlier than it was meant to. We broke all-time highs 250 days earlier than we were meant to, and now we're seeing what I think to be an extended, consolidation. Let's say a deviation level or consolidation after a deviation level upwards move. And so that seems normal to me. Perhaps Bitcoin is getting back on track to where it's meant to be in the cycle by seeing this extended consolidation, and perhaps a move upwards in September would bring us back to where we're actually meant to be, cyclically speaking. So I wouldn't get too concerned about the boring price action. It is certainly boring, but it is coming to an end shortly, rest assured. Now, this question follows up quite nicely from that previous question. When you say that Bitcoin needs to break above 64K to confirm a continuation to the upside, do you mean it on a daily candle close, weekly candle close? What am I looking for there? Well, let me just clarify. When I say that Bitcoin needs to break the center line of the channel, that's the resistance zone we're currently facing. I'm not talking about a macro continuation. I'm talking about a medium-term continuation. The macro continuation can only occur when the macro range, the channel itself, breaks either to the upside or to the downside. The medium-term continuation occurs when the inter-channel level, the inter-range level, which is the center line of the channel, breaks to the upside. That will occur at around 62K, but if we're talking about the indicators that are bolstering the center line of a channel, we're looking at about 64K. And so I would be looking for either a daily candle close or a clear flip of those levels on any time frame. It's not really about the time frame. I can't really give you a direct, we need to see this exactly. It depends on the context, right? If we see a daily candle close, but then it's clearly in a there's descending volume, there's RSI divergence, that would not be a flip, right? It really depends on the context. All I can say really is we need to see a clean flip of that level. Now, generally speaking, a clean flip is going to occur on a weekly close, but it can occur on things like daily candle closes. It can even occur on things like 4-hourly candle closes with resistance support flips and volume surges at the breakout. It's really contextual. But if you're going all the way down to the bone marrow, the most basic thing I could possibly say to answer that question, yes, weekly candle close, because at the end of the day, the bull market support band is a weekly candle level. And it's the top of the bull market support band that I'm looking at to be flipped, as that is the highest point of resistance that is bolstering the current point of resistance at the center line of the channel. Hope that makes sense. So weekly candle close, although we don't necessarily need to be waiting for it, we'll analyze it at the time. So 64K is the critical level I need to be seeing break on a medium-term time frame. And if we're going down to the very, very bare bones of the situation, yes, a weekly candle close would confirm that breakout. Here's an interesting question. Now, this guy's asking, what are your thoughts about exiting the market in regards to exit currency, i.e. should we exit into fiat, should we exit into stablecoins? Can you elaborate a bit on stablecoins? Are they, he uses the term, are they a proxy to fiat? I think what he means is, are they as safe as fiat, or are they akin to fiat? What we should be doing there. Well, I'll give you some general thoughts on stablecoins. I'm not going to answer your question fully there, but I'll give you some general thoughts I think about stablecoins in relation to fiat. Me personally, all right, I'll say this, and I'll say this from a point of regulation in Australia. I know the regulation is very similar in Canada at the moment, and it's going to get to the point, it could get to the point, especially depending on who gets elected, where it could be similar in the US. In Australia, it is becoming very difficult to actually get fiat onto exchanges, right? There's major banks in Australia. The Commonwealth Bank of Australia, the biggest bank in the entirety of Australia, is saying that you can only deposit 10,000 Australian dollars per month onto cryptocurrency exchanges, which is actually a very small amount for big traders, of course. And so that means that if you're in Australia, you probably shouldn't actually withdraw money into your bank account. You probably shouldn't actually withdraw with money into fiat, because it's going to become very hard to get the money back onto crypto exchanges when you actually want to buy, when you actually want to trade. So for me personally, for the sake of regulation, and this goes to Australian viewers, but it also goes to everyone in the world, regulation can come out of nowhere. It doesn't have to be mandated by the government. Banks could decide to do things. It's not just government, it's banks as well. If the bank says, hey, you can't deposit crypto, we're going to put a deposit limit on cryptocurrency because we want you to hold money in the bank account instead, or whatever their reasoning for it, they say, it's because there's scammers in crypto. That's their justification. I push back on that, but that's irrelevant. I think for the sake of having easy access to money to chuck into the cryptocurrency market at a whim, you're easily better off having money in stable coins, all right? You simply cannot afford to be fighting with your bank over the phone for days on end to let them release the deposit you've made into the crypto exchange, so you can buy an asset and it's already up 30% by the time you get through that process. You've got the banks freezing transactions, you've got banks restricting transactions, putting limits on transactions. Stablecoins are much more beneficial for that reason, from the regulatory perspective and for the perspective of convenience. But also in general, Stablecoins offer you something that fiat currency does not offer you. It offers you the ability to have self-custody of your assets. Now, I'm not saying anything. I'm not a financial advisor. I'm not even going to tell you what I'm doing, but I'm just saying that, look, it's probably not the best idea, just from a general perspective, to have all of your money in a fiat currency controlled by a bank, right? It might be a good idea to diversify and have some of your money in stablecoins, which are linked to fiat currencies, which move with fiat currencies, right? Which may have a degree of higher risk depending on the stablecoin, but generally speaking, historically speaking, have been perfectly safe, right? It may be a better idea to have at least some of your assets in that stablecoin, so you actually have control of the asset in case something happens to the banks, right? In case the bank screws you over somehow, you have control of this fiat, you have of this stablecoin, and it's in your custody. That's a very good idea. You can also, in the same way you have bank interest, you can also do yield farming with USDT and USDC, so it's not really a problem there. But yes, as traders, I think you'll find with most traders, they have a significant portion of money in. What are my thoughts on Elliott wave theory and Fibonacci retracements? Okay, Elliott wave theory, as many of you know, I think is one of the least reliable forms of analysis that you can do. I think it should be reserved only when you have nothing left in your toolbox, right? As analysts, we have a toolbox of TA, of different forms of TA that we can use to analyze charts, right? Patterns, we can use indicators, we can use momentum indicators, we can use fractals, we can use wave theory, we can use Fibonacci. There's so many things that we can use. And I think when it comes to the reliability of metrics of TA, first and foremost, you're talking about range reliability, cycle reliability, pattern reliability. After that, you're talking about indicators, then momentum. After that, you're talking about fractals, then wave theory, right? It comes in last, right? Elliott wave theory, in my opinion, is I barely ever use it because there's no justification for me to use it against if I have nothing else to use, maybe I'll consider using it, and even then I won't trade based on it. Like, there's just not really any scenario I've ever really had in my years of doing this where there's been no form of conventional TA that I can possibly use and I'm forced to use Elliott wave. Why don't I use it? I don't use it because it's way too subjective. Fundamentally, it's way too subjective. Fundamentally, I just don't think it works. It's the theory that most moves in financial markets happen in 5 steps, right? 1, 2, 3, 4, 5 to the upside. That's a 5-step impulse wave. And then we have 1, 2, 3, 4, 5 to the downside. That's a 5-step, corrective wave. But the reality to me seems very clear. Elliott wave is highly subjective. If you give 10 different traders 10 different charts, they're all going to come up with 10 different looking Elliott wave patterns, right? Is this wave 1 or is this wave 1, right? Is this 1, 2, 3, 4, 5, and therefore that was the bull market top? Or is it 1, 2, 3, 4, 5, right? And then there's a new one, 1, 2, 3, 4, 5. Or is it, is it 1, 2, 3, 4, 5. There's so many different ways you can draw these waves, and I understand there are technically rules to how you're meant to draw a wave, but I think generally speaking, what you'll find is that even when you apply these rules, there's no clear answer to what is the correct way to draw something. Therefore, it all comes down to Elliott wave theory bolstering personal biases that you already have. And if something bolsters your personal bias, it's not really a good form of analysis. It's not really an objective form of analysis, right? There's no way that you can look at a descending channel formation with concrete support and resistance and say, oh, this is bearish. It's simply not, because it's a descending channel formation. It's simply a bullish structure. However, if I look at this and I think, oh, this is an Elliott wave theory with 1, 2, 3, 4, 5, and I draw it different ways, then I can bolster my own personal bias and I can ignore the overall market pattern itself, right? The reality is we need to be hunting for forms of TA that are concrete. This is the problem with fractals as well. Fractals can be very easily manipulated to fit your personal bias. You can grab fractals from different assets, from different time frames, from 30 years ago, and you can apply it to now. It doesn't mean the fractal is valid, right? You need to be very careful with Elliott wave and fractals. You need to be very careful you're not selecting things that are just bolstering your personal biases and not actually valid. So that's my thoughts on Elliott wave. As for Fibonacci, I think Fibonacci does have some of the same pitfalls, right? You can draw Fibonacci starting from different places, but overall, Fibonacci is generally useful. Again, I don't think I don't think you should be using it over conventional forms of TA. You can use it in support of conventional forms of TA. If we just grab a Fib retracement just from the all-time high in 2021, for example, and extend it right across, you can see and just go to the bear market bottom. I mean, you can see that this has been vaguely useful, right? Especially the hot pocket here that we've got at 0.618 being the resistance zone here. That formed a neckline all the way to the ETF resistance zone. And we've also tested that for support recently on the recent correction. I mean, that's a good example of Fibonacci being generally useful on a macro scale. But again, I think that Fibonacci can also mislead people. It can get people to expect the price to move higher or lower when it's not actually going to do so. Like, for example, I know this is a terrible example because, I mean, the target's all the way up here, but say for example, we did break above the one zone on Fibonacci, which is at 69,000. People could expect Bitcoin to keep going upwards there and not correct downwards. Why would it correct downwards and get messy here? That's a terrible example, but on shorter time frames, that would make sense. The fact of the matter is we need to be trusting more conventional forms of TA more than we do more vague macro forms of TA like Fibonacci, like Elliot wave theory, like fractals, because they are subject to not only personal bias, but making you expect things that are not considered likely to happen via the conventional forms of TA, which you should be trusting more than these forms of TA. But yes, I would say that Fibonacci is generally useful. I don't necessarily disagree with the use of Fibonacci. I do use it myself on occasion. You've probably seen it on this YouTube channel before. Here's an interesting question about traditional market correlations. He says, Bitcoin is frequently decorrelated from traditional markets. What reason do we have to believe that Bitcoin will follow traditional markets if traditional markets pump, or even we can reverse that question. If traditional markets dump, why would we expect Bitcoin to go down? If traditional markets pump, why would we expect Bitcoin to go up? Well, the simple truth is, yes, of course, Bitcoin has been decorrelated to traditional markets in the past, particularly when it was very small, and particularly before 2020, before the first round of quantitative easing. But ever since then, for the last 4 years, it has been pretty much directly correlated. There have been periods of decorrelation. Okay, for example, we had decorrelation here when Bitcoin was going sideways for about 6 to 7, maybe I think it was 9 months. It was a long period of time, 6 months in 2023. S&P was going up and then S&P was going down while Bitcoin was rising, right? That is a period of decorrelation. Now, we had a period of reverse correlation, actually, which is quite rare. Now, decorrelation is not rare, but reverse correlation is rare. We had reverse correlation here. Bitcoin was going downwards, S&P was going upwards, right? That was very unique. That lasted about a month and a half. But if we're talking on a generalized scale, right, we can talk about the moments of decorrelation, the moments of reverse correlation, but on a generalized scale, if you zoom out in this chart, you can see very clearly that overall on a macro scale, these are correlated. I mean, there's no question about it, it's a fact. So when we're talking about macro events like a macro bull market or a macro bear market, we're talking about long term. We're not talking about the short term and medium term decorrelations and reverse correlation. We're talking about long term, and long term, these charts are correlated. So until proven otherwise, there's no reason to expect Bitcoin to deviate, right? If the S&P does pump, Bitcoin should pump as well. And that it's not because Bitcoin's following the S&P. It's because the same characteristics that drive the S&P to the upside drive Bitcoin to the upside as well. So it's very important to note, S&P 500 is not dragging Bitcoin upwards or dragging Bitcoin downwards. The same influences are influencing both assets, right? So when you understand that, you understand more clearly why they move together. It's not because they're getting dragged around by the other one. It's because, unless there's a complete change to what pulls Bitcoin up and down, nothing's going to change with the correlation. You'd literally need a shift in what moves Bitcoin to shift that correlation. About supply shock. What are my thoughts on supply shock with Bitcoin, with less Bitcoin being mined and more Bitcoin being bought up and the general supply of Bitcoin decreasing on exchanges? Well, I think it will lead to a supply shock eventually, right? Provided Bitcoin keeps growing, provided there are more buyers than sellers, provided we don't see anything weird happen to Bitcoin fundamentals, provided regulation doesn't shut down Bitcoin and decrease the amount of buyers, I think we will see Bitcoin on exchanges decrease over time. It was at 3.4 million around 2 years ago. Now it's at around 2.7 million. So it's decreased by 25%. Obviously, if it keeps decreasing, we will virtually run out of Bitcoin available on exchanges. And if we reach that point of low liquidity, we will see new inflows affecting the price massively, right? So it's very important to understand this. And this is something people misunderstand all the time. If you have Bitcoin at 1 trillion market cap, meaning that the total value of all the Bitcoins is $1 trillion, right? It doesn't necessarily take another $1 trillion to bring the market cap to 2 trillion, right? You don't need to have a whole new $1 trillion worth of money flowed into the market. You could simply have, let's say, 50 billion, And if the liquidity is low enough, the price will move disproportionately in relation to the new amount of money that's brought into the market. So if you have a low supply in exchanges, right, low supply in general, low liquidity, you can have Bitcoin moving upwards, gapping to the upside massively with very small amounts of money comparative to what it used to do when there was a high amount of supply in exchanges, right? Price movement is related to liquidity, and market cap is not necessarily what people can get out of cryptocurrency. If everyone sold tomorrow, you wouldn't get the full market cap back, right? It would be deviant. It would be based on liquidity, right? It's just the value of the asset at the current price right now. So market cap is actually somewhat misleading. We don't need a whole nother $1 trillion US to bring the market cap of Bitcoin to $2 trillion. We just need, it's hard to say what we need, but it could be much less than that depending on supply. So yes, supply shock is real, and provided Bitcoin keeps growing, it will happen at some point. And it won't just turn on one day, right? It won't be like one day it's not happening, and then the next day it is. It will be a gradual process where over time, the liquidity is lower and lower and lower. The amount of circulating supply is lower and lower and lower, and so the price will be impacted higher and higher and higher by new buys. And the final question, and perhaps the most important question, what strategies do you use to overcome psychological hurdles of trading, right? This is a great question. I love answering questions like this. I did a whole unit in my course that I made about this question, but I've got 6 separate, very important tips here. First and foremost, if you are falling subject, and everyone does, and let me tell you, even professional traders do. I do. Everyone does it. It's the most common reason traders lose money. You can know TA down to the T and you'll still lose money trading based on not knowing how to manage your emotions, right? For example, there's a great point that I've made many times over the course of my YouTube channel, not to boast, but it is, you can be a great analyst and be a terrible trader. There's a very big difference between being a good analyst and a good trader. An analyst simply does the work and makes predictions. A trader actually puts the predictions into action, right? So how do you avoid being a bad trader because your emotions are weighing you down? Well, number one is learning TA. You need to learn TA. If you're going into the market blind, if you're going into the market gambling, you don't know what's going on, you don't know how the charts moves, you don't know how to identify patterns, you're going to be more stressed out because you're gambling, right? It's like being at a casino or at a blackjack table. You don't know what's going to happen next. You have no idea what will happen next. Therefore, how are you meant to not be stressed, right? So step one is learn TA. That's just very basic stuff. Then we get into some more structured things, right? Or some more, I suppose, more hard to figure out if you're a beginner, right? Some actual important lessons here. Everyone knows you need to learn TA. You shouldn't be trading if you don't know TA, but here's some important stuff. You need to follow, or you should probably follow, a structured trading strategy, right? In my VIP group, for example, I post altcoin trading signals on Telegram. I have a structured altcoin trading strategy for the VIP members specifically, taking into account the fact that these VIP members probably are not going to have as much experience in the market as me, and they're probably not going to be able to easily maneuver through advanced trading strategies like I can as someone who does this full time, right? So I've got a structured trading strategy that I use specifically for VIP that I've tried and tested over the years, that I've got a track record for, that I've logged. I know it works, okay? It works at a lower success rate than my more advanced trading strategies, yes, but it still works. It's got a 78% win rate over the course of, 24 months of trading results. And I've posted that all public. It's all public information, right? So I'm not just making it up. You can go fact check me down below in the comment section or in the bio, but you need to follow a structured trading strategy. And furthermore, this leads into point 3, you need to identify your validation and invalidation zones, before the trade is even taken, right? You don't just jump into a trade mid-trade randomly, right? You don't just jump into a move. If the move's already broken out, if you've got a triangle formation and the move's already broken out and it's halfway up, you don't jump in halfway up. You jump in when it's broken out. You jump in when you see the breakout with the volume surge and the RSI breaking to the upside. You jump in at the trigger point, not halfway through the trade. And you're not going to be able to jump into trades at the trigger points if you don't identify trades before they have triggered, right? So you need to plan trades before they occur. When I'm hunting for trades, I'm not looking for trades in vicious uptrends or vicious downtrends already. I'm looking for trades that are consolidating, that have been pent up and are ready to move to the upside or the downside. And then when that move begins at the trigger point, that's when you enter the trade. It's called breakout trading. It's very important. So you need to follow a structured trading strategy, whatever that may be, whatever indicators you decide to use, whatever, What if you decide to use the RSI, you don't use it using volume, or you're not using it if you're using patterns, or you're not using them. You need to follow a structured strategy so you know exactly what you're doing. You need a clear path in and out of a trade, and you need to identify the trade, how you're going to trade it, what are your validations for entry, what are your invalidations, right? When will you scrap the trade? Okay, I don't want this trade anymore, delete it from the list, we'll go on to the next one, right? Before you actually enter the trade. So you know exactly what you're looking for, you know exactly when you're going to enter, and you know exactly what you're going to do after you enter. It's all very important to do before you trade. So it becomes very mechanical, right? Because that's the goal, right? We need to remove our emotions from the market. We need to become basically become as AI-like as we can. We need to become as much computer-like as we can. Emotions do not help in trading. You need to remove them entirely where possible, right? So the ways you can do that is fully understand everything about the trade before you take it where possible. And therefore, everything is logical at that point. It's all database, it's all probabilities. There's no emotion involved because you know what's going to happen. You know this is when you enter. You know that's when you close. You know when you're in the trade, if this happens, that's when you get out. There's no emotions in that, or at least it minimizes the possibility for it. Another thing is, don't revenge trade. If you do have a loss and you feel yourself getting upset that you had a loss, perhaps it was a big loss, perhaps you lost a lot of money, right? Don't trade again. Take a break, right? The market's not going anywhere. If you come back tomorrow, you come back in a few days, the market will still be there. There will still be opportunities, right? You're not going to wake up one day and the market's disappeared and you can't trade anymore. It's always going to be there. Now, it might be in different forms. It might move in different ways, but that's why there's different assets, right? If Bitcoin gets very, very large and it stops moving, it stops moving a large amount per day or per week or per month, right? You're still going to have altcoins that will. So take a break. You don't need a revenge trade. It's only going to lead you to ignore your strategies, which we've developed as we've seen above, learning TA, followed a structured trading strategy, identifying validations and invalidations. If you're emotional and you just lost money, you want to make it back desperately, you're more likely to enter bad trades. You're more likely to trade more aggressively and just lose more money and compile the losses. So don't revenge trade. Keep a trading log. That's a great thing. It keeps you in full understanding of how much money you've lost, how much money you've won, or profited, I should say, and what is your track record. So if you're following a structured trading strategy and you've got a 65% win rate and you lose a trade, but then you look at your trading log and you see you've got 130 trades there and you've got a 65% win rate, it's much easier for you to accept the loss because it's just part of the probabilities, right? You're not going to win every trade. We know that. Nothing's guaranteed. If you have that trading log, it's part of the probabilities. You understand, okay, well, this overall is a 65% win rate, so it doesn't really matter if I have a 3-trade loss streak. I know that generally speaking, over the course of history, this trading strategy has been beneficial. Therefore, I shouldn't just give up on it because I've had a 3-loss streak. This is just bad luck, right? It also helps you track, strategies that don't work. So if you've got a trading log for a specific strategy and it's clearly not playing out well, you've done 90 trades, or let's just say 30 trades, and you've got a 25% win rate, it's pretty clear that trading strategy is not going to work. It might be time to try something new. It also just keeps you in check about how much money you're actually losing if you are losing money. If you've got this log sheet and you're $30,000 at loss, it might be time to start, backing up with the trading and getting back to the theory and learning TA a bit better. And this is kind of broad, but I thought I'd add it in there. It's important to manage risk, guys, right? We can't be entering trades with 50% of your portfolio every single trade. It's just not a viable strategy, right? You're going to have losses. Even with the VIP trading strategy that I have that has a 78% win rate, I mean, you can still have 5-trade loss streaks, right? We had a 6-trade loss streak in early 2023, and that's with a 78% win rate. Right? It happens. It's just maths. So if you're trading with large portions of your portfolio every trade, and you do happen to hit a loss streak, you will simply lose everything. So you need to manage your risk. And another thing is, again, this goes back to following a structured trading strategy. Trading strategy is that if you're about to enter a trade, okay, you should probably point out where your stop loss is going to be, right? Is it going to be a 10% loss, a 15% loss? And if the loss is going to be higher, the profit potential better be higher as well. You need to have good risk-reward ratios. So manage your risk not only by cutting down the amount you're trading with, but also by identifying the risk-reward ratios and setting in relatively hard concrete terms where you're going to be cutting your losses at. Now, obviously, you can leave room for adaptability. You need to adapt to some extent. But if you're just adapting for the sake of adapting because you don't want to exit the trade because you're scared to lose money and actually click sell and sell at a loss, then you're running into some problems there. So be sure to manage your risk. And obviously a lot of this is easier said than done. It's all very easy to say. I mean, really, I can sit here all day and talk about how you should be managing risks in trade and how you should be avoiding emotions in trades. But, you know, I fall to some of these pitfalls as well sometimes. Everyone does. It's literally just a part of trading. It's about decreasing the amount of issues you have with emotions. And the way you can do that fundamentally is just learning how to trade better, learning the theory better, learning TA better. That's the best way to decrease your emotional your emotional vulnerabilities in trading, because if you understand things better, there's no question marks anymore. The question marks go away. And when there's no question marks, there's no mysteries, it's very easy to just act logically, right? Okay, guys, I hope you found that video useful. I think there was a lot of good content in there. Hopefully you can harvest utility from it. If you enjoyed this video, please leave a subscribe, a comment, and a like. It really helps the channel in the algorithm, and subscribing, of course, helps you keep up to date with the content I post in the future. And I will be posting more useful content like this in the future. Go ahead and check out the BingX and Bit2Nix exchanges. Both are global non-KYC. You can sign up from anywhere in the world with a 15% trading fee discount exclusively with my link down below. Every single buy, every single sell will be 15% trading fee discounted. You can save yourself thousands of dollars just by using my links there. Sign up to those exchanges. They've never been hacked before. They're low in trading fees, even lower with my links. Going forward, we have the VIP group on Telegram, guys, right? Altcoin trading signals. I post them 4 times a week. I give you buying strategies for altcoins, selling strategies for altcoins, right? In short and long scenarios. I also give you, basically access to a group chat there, 115 other VIP members. In that group chat, you can discuss the market 24/7. You can share charts, discuss anything crypto related, very useful stuff. And we've got our track record there, fully transparent, all of our trading results for the last 24 months of trades. So I'm not hiding a thing there. It's all very good. 78% win rate. Moving forward, and we've got the last thing here, which is the Become a Trader 10-unit course. This course will teach you everything you need to know about TA and trading. It will also go very deep into market psychology, which we discussed briefly today, but mainly it's predominantly focused on TA itself, right? Fundamental concepts, technical analysis, market patterns, indicators, candlestick patterns, all of that is covered in the course. It's on sale right now, so if you're interested in learning how to trade, you can do so with that course. Check it out. The information's down below. Thank you guys for watching. I hope you enjoyed, and I'll catch you in the next video. Cheers.